will it be a cut or a hike next time we see it? Is the balance equal? Is one more likely than the other?
I watched all of Steve's interview with Janet, and if you listen carefully what she said, it was the way you asked the question, Steve, and she said, of course it's possible. Everything's possible. It's also possible on the other side. She also said that had she been plotting the dot in December, she would have been thinking of 2 rate rises this year. So I don't see any news whatsoever in what she said. She was typically cautious, very central bankerish, and I don't think the issue is one of cutting rates. The issue is, do you hold still?
Richard, I'm going to push back. I watched the same interview you did, and I thought that she was much more anxious, worried. I don't know, Steve, you were in the room.
I know Janet.
I don't like to argue with Richard because I've got a lot of respect for Richard. But Richard, I know Janet well. I know you know Janet well, and I don't think she'd be talking about the possibility of a cut if she didn't really think that we were sort of on the fence right now, and the economy could go either way.
I think you're making, Steve, I love you. You and I are good buddies, but I know Janet probably better than anybody who's not served on the committee with her for a very long time, when she was a bank president, when she was vice chairman, when she was chairman or chairperson and chair. But again, she was asked a question. She answered it honestly. Everything's possible here, and I agree with her, and I would have answered it the same way. I'm not advocating one thing or another. What I am worried about, though, you mentioned some good points here. The German IP numbers today were awful. Mm-hmm. The Singapore export numbers and trade numbers were terrible, and really show they're on the brink of contraction. We have a very weak UK number that the Bank of England just reduced their growth numbers significantly downward. So the world is not in good shape. We happen to be, as Yellen pointed out in your interview, doing quite well domestically. Are we able to continue to do that or not? What I'm really worried about is neither the European Central Bank nor the Federal Reserve of the United States has enough ammunition in their pocket to mitigate a downturn. And this is the big concern I have. I don't think the crisis has occurred yet, but when we begin to see the economy roll over, we don't have much to cut. Well, Richard, we don't have much of a balance sheet to expand. So that really worries me. And that's, I think, something that people will begin to light on. Certainly in the case of the Europeans, as you know, negative interest rate debt now has climbed again to about $9 trillion. You can't continue this process forever.
So what does happen if there's no dry powder, so to speak? I mean,
but I mean, that's a $64 trillion question. I'm not sure.
There's nothing on the table. There's nothing. You don't think any of these central bankers have thought about this? I mean, what do you think? There are no other tools that could possibly be used?
Well, negative interest rates, we know, do enormous damage. It is a total misallocation of credit. I think the Fed has learned from watching the Europeans. They don't like the way the ECB has gotten themselves into a trap. We know the effect it has in Japan, and we also have seen the effect, say, in the Nordics. So this is really the issue. Now, central bankers are creative. I think we showed that under Ben Bernanke's leadership during the crisis. They certainly will be thinking this through. They're long-term thinkers. And a very able independent body. That was important in the town hall that was held last night by Jerome Powell, the chair. So, but this is my concern. We didn't move enough on the upside. We're at a point where it's beginning to bite, and there's not much to give back. You want to have money in your pocket to spend. And what that means in Fed speak is you want to be able to cut rates to mitigate a downturn. Inflation is not the issue here. Would deflation be the issue in the future if we had a weak economy? Possibly. So I do think, Steve, we have the possibility here of at least holding still for quite a while. We'll see what happens in the global economy, but we'll see if it infects our economy, and we don't live in a world all by ourselves anymore, so it's a high probability.
Richard, I want to switch focus a little bit and talk about the banks merger that we've seen this morning, BB&T and SunTrust creating the 6th biggest in the U.S. What's your take on that, and what do you think the regulators' take on that will be?
You know, I don't know. Quarles is a very good leader on the regulatory side at the Federal Reserve. We have to see what the other regulators are going to say. I presume this was well tested beforehand. I presume there were discussions beforehand. There are probably assets that have to be shed or coverage that has to be shed. It would be the 6th largest bank in the United States, but it's dwarfed by the big giants, the big 3 in particular. So We'll just have to see. Now, they are going through a new series of stress tests on a really horrific outlook possibility. If that were to happen, what do these different banks have to do, or how do they shore up their capital, et cetera? That stress test mode is just beginning now. And again, this has to be considered within that context.
Hey, Richard, I have to say, I cover Randy Quarles, and it's tough for me to get a beat on him, in part because, you know, you want to say, okay, he's a guy, he's deregulating now, he's going back, but that's not strictly true.
Agreed.
In some places, it looks like for the biggest banks, he's either as tougher, maybe even a little bit tougher, especially with these liquidity ratios. Get down to the next tier, which is where this merger is taking place, and is a little bit less stringent. So I wonder if you could tell us your sense of the broad drift right now of bank regulatory policy. Is it more favorable for the banks? Is it less favorable?
Well, we had started the process going way back when Dan Tarullo was overseeing as a governor the regulatory side. The bank presidents, including me and especially me, were pushing very hard to raise the level of scrutiny to $250 billion in assets.
Right.
That's been done. Quarles has been quite effective in making sure that is the case. It lessens the pressure, or put it this way, it gives a little more leeway to the regional banks, in particular the larger regional banks and the community banks, and that was just. So they will be subject to less immediate examination, and the stress tests will be a little bit different. The main thing are the so-called SIFIs. As you know, Steve, my least favorite acronym. Sounds like something you might catch in a bar late at night or something, a SIFI. But, you know, I think that's where the scrutiny should be. These are systemically important institutions, the big banks in particular, not the insurance companies. And that's where the level of scrutiny is enhanced, and I think it's the right thing to do.